It's happened. House prices have dropped for the first time this year, and mainstream media, who you could say like a little bit of bad news, are absolutely eating it up.
The comparisons are bleak, the predictions dark, the economy set to plunge into a decline of historic proportions.
Thanks, Channel 4. Had a near-on emotional meltdown this morning listening to that. Ruined my Nutella on toast.
It's news to wipe smiles from faces.
Yep, exactly that. Look, let's lighten the mood a little, shall we? In the tale of the wolf and the three little pigs, just a simple breath from a motivated wolf was enough to bring the homes of two of our unfortunate pigs tumbling to the ground. In many ways, media headlines could be described as the modern-day wolf. The sight of them creates panic, and they're both typically full of hot air. I guess that makes the housing market the pigs in this story. But unlike our porky protagonists, we don't build our houses out of straw. We use bricks and cheap-ass plasterboard. Rock solid. But can the same be said for these housing market predictions? Has the housing market in the UK started to crash? I went through 50 years of market data looking for the answers to that question, and the results, well, they might just blow you away.
I'll huff, and I'll puff, and I'll blow your house!
All of this noise has been sparked by this 9-page report from Rightmove, which looks at average asking prices of homes, and this one as well, from Halifax, I keep all my paperwork on the floor apparently, which says basically that house prices in the UK have dropped 0.1% in the last month. But really, it's this one from Rightmove that's got people all kinds of stirred up. As they say, the average asking price of a home in the UK has dropped 1.3% in a month, shaving around £5,000 off the average asking price for a home.
What? Sorry, yeah, that's gone.
Now, the educated opinion would state that the cost of living crisis is making people poorer. At the same time, interest rates are rising, meaning mortgages are becoming more and more unaffordable. This combination of less money and increasing costs is now affecting prices, and they're finally starting to fall. But don't get too excited yet, first-time buyers. Rightmove thinks there's a far simpler explanation for these price drops in August, and instead of it being about the cost of living, they think it's more to do with the Costa del Sol. Rightmove report that prices tend to slow in August when everyone is on holiday, and this 1.3% drop is on par with the average August drop over the last 10 years. Now, I don't want to take a statement like that on face value, especially from a business that generates all of its profits from the property industry. So I had a look around for the average asking price data for August for the last 10 years, but I just couldn't find it anywhere. All I could find is crappy graphs like this that really don't tell us much. So I went on the Land-registry website and ran the data for the last 10 years. This isn't asking price data, it is the actual sold price data, but it would make sense that if asking prices fall in August, we should also see the price growth fall by a similar amount. I'll link the site below for you. First of all, just looking at this graph, we can in fact see that July often marks a peak of sorts, and it's typical for price growth to drop off in August. So I then pulled off the data for every August in that 10-year period. Makes it sound like I did loads of work. In truth, all I did was click this button here. The average price growth in the last 10 Augusts was 0.79%. Again, actual price, not asking price. But let's just run with this holiday theory for a moment. For many people, this is potentially their first summer holiday since lockdown, and so more people are currently away. This means anyone who is selling is likely pretty motivated to sell and is willing to offer a good price to do so. The key thing is the motivated seller part, but we'll come back to that in a minute. Just to quote Rightmove, sellers are pricing more competitively to secure a buyer quickly, to beat the lengthy average time of completion and move before Christmas. So yeah, both asking prices and real prices are falling at the moment, and that will probably continue. But it's important to point out that a decline in August isn't uncommon. To be honest, a decline in values in any month is not uncommon. This chart shows all the monthly price changes for homes since the year 2000. Notice how we have loads of months that fall below this line, meaning prices fell. If we then overlay this chart that shows average house prices, we can see that long term the price movement is upwards, even with this month by month carnage. In the 269 lines of data I analysed that made up all the average price movements from the year 2000, 86 of them were declines. 31% of all the months since the year 2000 have resulted in a decline in house prices. Now, we could sit here and say that since the year 2000, we've had a few major issues with property, namely the worst crash in housing prices in living memory.
That's America's housing market.
So I then ran the data all the way back to June 1968, which is as far as I could go. And I found that over that period, which was a total of 649 months, 114 months saw a decline in property prices. That's around 17% of all the months saw a decline in property prices. There's three things we can take away from this data. One, it's kind of grim that 1968 was only 649 months ago. Sounds so short. Two, declines in house prices have become more common since the start of the millennium. And three, declines in house prices in any given month have always been pretty normal. I guess the headline of house prices dropped in August, but that's pretty normal in the grand scheme of things doesn't quite grab your attention like
decline of historic proportions.
But let's not be flippant here. Maybe house prices have just started to crash. I mean, it feels long overdue, doesn't it? I don't need to look at data to tell you that the house prices in the UK don't make any sense at all. The prices of property, like anything in life, are a feature of the relationship between supply and demand. So supply is the amount of homes available to buy, either through people selling their home or new homes being built, and demand is the amount of people that want to buy those homes. Falling house prices tend to happen when there's lots of motivated sellers.
Wow, a lot of people seem very motivated.
Not just the ones you get in summer who want to move into a new home before Christmas, but loads of motivated individuals who need to sell their homes. I'll just read out a quote from Zoopla. House prices only tend to fall when there are forced sellers. That's people who can't afford their mortgage and have no option but to sell. So it makes sense that rising mortgage costs could force people to need to sell because they can't afford the new higher cost of the financing on their homes. Now that means then more houses come to the market, which is more supply, and if demand stays the same, if the demand for homes doesn't rise to meet that increased supply, you could expect prices to drop. But Zoopla also say this. In the UK, less than half of homeowners have a mortgage. 85% of those who do have mortgages are on fixed rates for 3 to 5 years. This insulates the market from short-term changes in mortgage rates. We also already have tough affordability checks for buyers. History shows that falling house prices tend to be preceded by looser lending standards. Looser lending standards, like the ones we saw in 2008, where 20% of people with a mortgage in the UK had never even proved they had an income.
No income, no job. I just leave the income section blank if I want.
Just try getting a mortgage nowadays without proof of income. But these fixed deals that people are on and the stricter lending criteria mean rate rises aren't felt by individuals instantly. This is why this relationship between supply and demand isn't simple. It's not like, oh, this happened, so this will happen. Let me explain. Higher interest rates mean the cost of mortgages become more expensive, meaning people have less affordability and can't afford to buy a home. This will of course affect demand for homes as people can't afford to buy them, but this very same higher interest rate might put people off from moving. People might sit there and go, why would I sell my house now to move on to a more expensive mortgage when I could just stay in the one I'm in, thus reducing supply. So the same factor that affects demand might just affect supply. Or another example, Citigroup says inflation will hit 18%. If that's true or not, I don't know, but it serves to illustrate a point. If it did, you can expect as a result the Bank of England will raise rates pretty high to combat this. You would then expect that to affect demand because individuals can't afford homes because mortgages are becoming more expensive. But what happens if a load of first-time buyers think, I best buy a home now before rates go up any higher, and then thus more people flood to the market to take advantage of the lowest rates they think are possible now in the anticipation that they think rates will get higher in the future, thus increasing demand for property in the short term. The relationship between supply and demand is far from simple, and there's just so much undiscussed nuance in every headline that's shoved in our faces, so much more context that needs to be given that they just don't provide. UK mortgage lending slows unexpectedly as borrowing costs rise, and they support that with this graph, which does indeed show a decline in the rate, but this decline they speak of is all off the back of this period right here. We saw this huge decline right here when news of COVID hit, then a massive spike in mortgages when stamp duty was frozen. Is this a decline as Bloomberg are framing it, or is it just a return to normal levels? How about this one? Buyer inquiries to agents are down 4% on the hot market of 2021. That sounds scary, right? There's your less demand right there. But here's the kicker. The demand is still 20% higher than in 2019. It just makes me laugh that the mainstream media are predicting a crash, and the data they're quoting is predicting prices will keep growing. Rightmove says that asking prices are up 8.2% in the last year, and forecasts are that house prices will increase between 5 and 8% over 2022. Funny looking crash that, ain't it? Look, I don't want to sit here and sound like I think property prices won't fall. I think that's all part of the natural cycle of property or any other asset class for that matter. The point I want to get across, the point of this video is, a crash isn't the only outcome. We could see a crash as people come off their fixed rate mortgages. Around 1.3 million people are on fixed rate mortgages that are due to end this year. They could be then hit with the higher costs and forced to sell their homes, meaning we have motivated sellers.
Sell it all.
Or maybe we just see a slow decline in prices. Or what about just prices staying flat? A stagnant property market where prices remain flat allows people's incomes to catch back up and for affordability to improve. All I'm saying is, it doesn't all need to be Nutella spoiling, pulse racing, high drama at 7 AM on a Monday morning. It's ruined. The state of the housing market in this country is a joke, and I'm not going to harp on about it because we all know it's the case. But the media's obsession with housing crashes is an even bigger joke. One bad month of data, 1 month of declining prices, and they're just up in arms.
I want you to get mad.
For these changes, for these impacts to take hold, takes time to materialise. The housing market is just as complicated as the stock market, and sure as hell no one knows what's going on there on a day-to-day basis. So why would anyone be able to predict which way the housing market was going to go with any form of certainty? It takes time for the impact of interest rates and the cost of living to be felt by individuals. The data put forward in these 9 pages is the aggregated average of millions of people's real lives. Jackie and John from the wheel aren't sat there going, Jesus Christ, we need to get out of this gaff now. Rightmove just said August prices are down 1.3%, and this neighbourhood's going to shit. There's some wolf out there blowing on the shed. The fact of the matter is, these big crashes, these collapses in house values in a short amount of time are really rare. But in this modern world of the internet and massive data sets compiled by the likes of Rightmove and Halifax, where they compare every aspect of a property deal all the way from the asking price to the final sold price, we end up sitting here looking at all this data going, oh my God, this is the worst price decline on a Tuesday in the last 10 years. And that just puts people off from buying because they're constantly panicked that the bottom's going to fall out the market. I mean, just take a look at this. This is a headline from 2018, and this is one from 2019, and this is 2020. Imagine if you'd listened to this and played into that fear and not bought at that time. Where would you be now? I mean, look at this one. This is the most recent. Monthly housing data doesn't mean ball all in the grand scheme of things, and trying to predict which way houses are going to go based on data sets like this is about as good an idea as standing in your back garden in a cheap wolf costume trying to blow down a shed with a sharp exhale of breath. In my opinion, which you definitely shouldn't listen to and people are going to disagree with, but that's okay. But if you're looking to buy a home to live in as your house, then just get on with it. It's not an investment anyway, and you're going to probably be better off than if you were just renting. If you buy your first home and the prices drop, say 10% on a £200,000 house, yeah, sure, you just lost 20k on paper, but really that 20k wasn't even yours anyway because it was all just mortgage debt. And the only saving you really could have made is probably £2,000 on a 10% deposit, which is just a couple of months' rent anyway. And now you have this asset under your control that's probably on a really cheap interest rate, and the value of the debt that's associated with that interest rate is being eroded by inflation for you. Let's say your mortgage is 3% and inflation is running at 10% on a fixed loan of £180,000. That is great for you because you're getting to pay back that 180k with money that's worth less than when you borrowed it. Remember, inflation is the destruction in purchasing power of money over time. So the 180k they lent you is worth more today than it will be in, say, 20 years. Inflation allows borrowers to pay lenders back with money worth less than when it was originally borrowed, which benefits the borrower.
Might want to hang on to that one.
It's a completely understated benefit of having a mortgage in times like this, and while people sit there worrying that they might be able to pay 2k less on a deposit if prices slide 10%, they don't realise that the debt they could take out against that property is being eroded by inflation at a much higher rate at the minute. The key thing is stress test your mortgage at different interest rates to ensure it's affordable and continues to be so, even with higher interest rates. Don't overcommit on a big home. If you're looking to invest in property, when I used to sell investment properties in Manchester, I'd just say to clients, just focus on the cash flow. As long as the property yields you cash on a monthly basis, so it covers all of its costs and produces an income for you, then the price behind the scenes is anyone's guess. You don't buy an investment property banking on the price going up, short term, medium term, whatever, because you can't control that. What you can control is how much income that property makes you on a monthly basis. And then whatever the prices do behind the scenes going forwards, it doesn't matter because you're never underwater with the property because you're always covering your costs. We know as long-term investors in stocks that trying to time the market is a mug's game. So why would property be any different? Will prices fall at some point? Almost certainly. Property goes through cycles just like any other asset class. When will it happen? Nobody knows, especially mainstream media. Would I let that influence my decision to buy a property? Not by the hairs on my chinny chin chin.